We're in a large consolidation here, buy side here. The market rallies up, creates another area of equal highs. It drops back down. Where's it dropping down into? Inefficiencies here. And look real close. You see that right there? Look at the bodies of the candles. That's the narrative. That's the real story is in the bodies. The wicks do the damage. Yes, we wicked through it, but look where it closed. We traded down. Look at the bodies close right there. That's consequent encroachment. That's the midpoint of that gap right there. So 41.82 and a quarter. The open on this is 41.82 and a quarter. Oh, look at that. Inversion fair value gap. If you ever have an inversion fair value gap, and here's for your notes, folks. If you have an inversion fair value gap like that, and you have a fair value gap that's just below that level inside of your dealing range, meaning you have this low to that high. This inversion fair value gap, we would want to see it trade through that because we're bullish. Buy side, it rallies through it. We expect, ICT, tell me how to know when the fair value gaps shouldn't close in. Here's one of those signatures. Inversion fair value gap, all this area should stay open, or a portion of it should stay open. Okay, so in other words, it would look like this. This is what you would anticipate as a fair value gap. Some of you would see this entry in this shaded area here as their multiplier, meaning that they would go long when price dropped into it right there. Other students would see this and say, okay, I want to see it show me proof with the bodies respecting either consequent encroachment or the high of the fair value gap. Is there any body closing at the high? No. We do have a body close right here on this candle at the consequent encroachment. As soon as it does that, we now can trust that this area here should not be traded down into. Technical science, baby. Take notes. So this run here goes for what? It takes out the buy side liquidity. Now, folks that just simply watch one of my videos and they see the relative equal highs and relative equal lows that we like to target. We don't look at this as we can trust this as a short. We want to see something that's going to be at a later time used as a long to go right back there and target those individuals. So this area here would be a buy side liquidity pool. Okay, so that would be a first partial. If a student would use this entry on this fair value gap, they could use this as what specifically? What kind of entry would that be? Institutional order flow entry drill, meaning that you're only needing it to go to that level or just below it of this fair value gap. Trusting, because we have an inversion fair value gap here, that's going to support price if we get a signature showing that either one of these conditions occur. A body closes at the high or closes at the consequent encroachment. As soon as that happens, the algorithm will immediately spool and go the other direction and aim for delivery to the upside, going after buy side or in an inefficiency above old highs. Buy side's here. It draws to this area here, right in here, and then what do we get? Open, immediate rebalance, bang, hits it. If you get an immediate rebalance, you know where it's going to go. I told you weeks ago that it was going to go up here. Even though we took out buy side here, how do you know when it's going to take out relative equal highs and reverse, or when it's going to keep continuing? When you have a higher time frame PD array that has yet to be traded to. So I'm not going to look at these equal highs being traded to and then reject and go lower. That's just a partial, and I'm holding on, looking for higher prices and running into higher prices still.